Hello and welcome to another video. I'm Adi from Pixel Profits and this is part 2 in my series of videos on market structure. This one is going to focus on trend reversals. So we're going to take everything that we've learned from the first video in the series and put it together with trend reversal patterns to get an overview of how external market structure moves. So if you haven't seen that first video, I'd highly recommend that you check it out now before watching this one. The concepts from that first video are vital to understanding what we're going to cover here. So there's going to be a link to the first video appearing on the screen now. Now, if you did see the first video, I hope I've given you a basic understanding of expansions and pullbacks, breaks of structure, strong and weak structure, and the tasks of highs and lows. You should also understand the concept of failure versus success. And I made a very brief mention of external, internal, and microstructure as well. Don't worry too much about the types of structure though, we're going to cover that in much more detail soon. As for the other stuff, if you're not sure about anything I just mentioned, feel free to go back and look at the first video again. We'll be going over all of these concepts many more times in the videos to come, so you will get plenty of refreshers on these things. Okay, so let's get started. So here on the screen we can see bearish and bullish reversal patterns. And these are going to be vital, so burn them into your mind right now if you can. I'd recommend that you practice drawing them out yourselves on a notepad, or even better, on your own charting software. I'm using TradingView for all my videos, so if you want to check it out or follow along with the video, you can follow my link in the video description below to TradingView. There's a free version that you can use, so there's no reason not to take a look. And if you do sign up to any of the plans, it would help to support the channel at no extra cost to you. So feel free to do so if you want to. Okay, so what are these diagrams then? Well, first, they might look like common reversal patterns that are seen in retail trading, and you'd be right. They can be called Quasimodo sometimes, head and shoulders, inverse head and shoulders, perfect head and shoulders, king's crown, and probably a load of other things. And the name is really the least important thing. What's really important is how we're going to use them and how we're going to go much deeper into them in the future videos to see that within these structures there's even more value and precision that we can gain than when we're using a traditional head and shoulders like the tool that you can get on TradingView here. People just kind of look at the neckline, and when it gets broken, that's it. But we're going to go into much more detail than that. Okay. But what I want you to know then is that the name really isn't important, as with anything in trading. It's just the way we're going to use them and how we're going to actually use them as part of our analysis. So we're looking at these reversal patterns to represent the overall market structure, with the internal and microstructure forming within these overall trend structures. Okay, so that would look something like this. Okay, and we looked at that in the first video. But for now, we'll ignore that, because what we're going to think about now is that when we see one of these structures on the current time frame that we're viewing, then we can say that we have a reversal pattern forming on that time frame. Okay, so something important to note is that if we see a reversal pattern forming on a smaller time frame, let's say the 15-minute chart, for example, that doesn't mean that the overall trend is reversing on the bigger time frames, like the 4-hour here. The reversal pattern is only relevant to the time frame that you're currently viewing it on. So if you did see a reversal pattern on the 15-minute chart, and let's imagine that you see one forming at this high here. Okay. Sorry. Ignore that last piece there. So if we see this reversal pattern forming on the 15-minute chart, that doesn't mean that the reversal is happening on a 4-hour chart. So the overall 4-hour trend isn't reversing. What's happening here is that we're forming a reversal pattern on the 15-minute chart to facilitate this pullback or expected pullback. The same if we place it here. Okay, we're expecting this 15-minute reversal pattern to form the pullback of the 4-hour. And then what would we get down here? We would get another reversal pattern, a bullish one this time, forming at the low here, pushing the price back up in this expansion move. Okay, so that's not too much to worry about now. It's just to introduce the concept to you. We're going to come to that in much more detail in the future. Okay, so we're just focusing on the overall external structure of the 4-hour chart. So let's take a look at how these form and what the actual important parts of them are that show us that the reversal is happening. So we'll start off with the bearish example here. So there's two main things to note that are really important. The first thing is the first point of failure. So when strong structure doesn't hold and creates a breaker structure in the opposite direction to the current trend, we know that something is happening. So if we take our trend here, okay, we've come from a low, we've formed a new high, we've pulled back, formed a low, and that would be, say, a higher low, okay? And then we've broken structure to the upside. This is exactly what we expect in an uptrend, okay? So expansion, pullback, expansion that breaks structure. So that makes this our 4-hour strong low, okay? And what we expect then is that when price has broken this with the breaker structure, it creates this 4-hour protected low, or strong low. And what we expect then is that when price comes back down after it's formed the high and it has a pullback, we expect the pullback and then a further expansion, okay? But what we get here instead, as you can see, is the price comes down and breaks through this 4-hour strong low. Now, what does that mean? Well, instead of now being a strong low then, what we have in its place is a break of structure to the downside. Now, that's the opposite of what we were expecting. So the first point of failure is the failure of this low to hold price up, as we expected the pullback to only come down into this area somewhere and then continue. Instead, we got a break of structure breaking through this strong low. So that's our first sign that something is wrong. The second sign is right here. Because when we get a break of structure, what do we expect? Well, we expect a pullback, okay? Just like we had here, okay? We had a, let's say, a previous break of structure down here, and then we got a pullback, and then we got a break of structure, we expect a pullback, and so on. So after a break of structure, we get a pullback. Now, here, we do get the pullback, but what we'd expect if we wanted the price to continue upwards was we want this to happen, okay? Even if we got this break of structure here, you know, perhaps it's just a sort of fake out or, you know, liquidity sweep of some sort in order to fuel the move higher. But we don't get a move higher. We get a move back into these previous areas, and then we get a move lower, causing what? Yep, you probably guessed by now, another break of structure lower. Let me just clean this up. So where this low failed to be strong, okay, it became strong here when it broke structure, but then it failed to hold price up. So that's the first point of failure. The second failure is of this low to create a new high. So it hasn't been able to create a new high, and that has resulted in the price dropping, breaking structure again to the downside, and now we're in a full-fledged downtrend with these expansions and pullbacks, right? Now, what could happen is we could come right up almost to the high and not body close above it, but what we could have is a wick reaching up. Now, if the candle that fails to close above this high creates a wick that goes above it, that is not, as we know, a wick is not a valid break of structure. Okay, a wick is just a manipulation or a liquidity sweep or whatever we want to call it. We'll come on to those later. But it's just to grab extra fuel to fuel the move down. So you could get a move up with a wick, but then the candle fails to close outside of that high. That is also a failure. So either way you see that, it's failed to do, this low has failed to do its job. So basically all of this failure ultimately leads to the reversal. And another way of saying it is that we flipped from an excess of demand in the uptrend to now an excess of supply. So there's lots of sellers and they've taken over control of the market. Okay, so now let's take a look at the bullish example, and you'll be pleased to know that it's literally the same thing flipped upside down. Now I know that sounds simple enough, but it's quite common to find one of them much easier to identify or understand than the other. I don't know why. It's just how our brains work sometimes, I guess, and it's totally fine. So if this is a little confusing at first, don't worry. You won't be the first person to think so. Just take your time, rewatch the video if you need to, and it will soon become clear. Okay, so the bullish reversal pattern then. So exactly the same concepts apply. We're moving down in an expansion and a pullback, and an expansion, and we expect another pullback. What we get though is our strong high failing to hold price down. Okay, we expect the price to return up, and then before it gets to our strong high, we expect the price to go down. But instead we break above it. Okay, so instead of this being strong structure now, what we end up with instead is a break of structure. Now, before we were breaking structure to the downside, and we expect that to continue. Now we've broken it to the upside. So there's our first indication that something is wrong, and our first failure of our strong structure to hold price below it. Now when we break above, we come back down, and now what would we expect if we were going to continue to trend downwards? We'd expect this low to get broken and causing a break of structure, and then a pullback, a pullback and expansion downwards again. But instead, we get the break of structure to the upside, and we get a failure of this high to make a new low. So it's now made a higher low instead. And that means we are very likely to reverse. So there's our 2 points of failure. This one failed to hold structure, or to protect the structure, and got broken through. And then this one came down, failed to put in a new low, and instead continued upwards. And when we see this happening, what do we know about this high now? It becomes weak, right? A weak structure gets run through. And that's exactly the same thing over here. When we see that this breaks structure and we get our pullback, when we see price starting to reverse down again, we know that this is going to be a target as a weak structure, weak low, that's likely to get run through. Okay? And that really is as simple as it gets. So take a moment to think about all this. It's taking all the concepts of strong and weak structure, breaks of structure, success and failure of highs and lows to do their jobs, and expansions and pullbacks, and it's just mashing it all together using a set of fairly mechanical rules to determine where price might go next. We have only really just scratched the surface so far, but maybe you're starting to see that by applying the rules that we've talked about in the first two videos so far, that you're already starting to develop a better sense of how price moves. And nothing's ever guaranteed in trading. Price can always do whatever it wants, whenever it wants, and it doesn't have any obligation to follow our expectations or rules. But what we are ultimately dealing with is probabilities, and trying to put those probabilities on our side. So let's have a look at how this would actually work if we combine the two. Okay, so here we can see a diagram combining all of the concepts we've learnt so far into one, well, overview of external market structure and how it moves. So we've got our series of expansions and pullbacks, okay, in our uptrend, higher highs and higher lows. I've used these rectangles, as we talked about in the first video, just to illustrate how we can track our lows and highs, okay, or our strong structure and our weak structure. So the top of the rectangle represents our break of structure, and the bottom of the rectangle represents our strong or protected structure. As we go up, we can draw these over and over. If we want to, I don't want it to get too messy here. Okay, so draw these out like this. Okay, and we just continue bounce up. I don't want to draw too many because, you know, you get confusing, but I just wanted to illustrate these just a couple of times on the chart, just so it doesn't get too messy. So we've got all our breaks of structure going upwards, as we can see, and we break structure as expected here. But then instead of pulling back and continuing, we come down, and I'll talk about what this is in a minute. We come down and we break structure to the downside. So whereas we were only causing these break of structures the upside, we then get the break of structure to the downside. So the first point of failure is this strong low, because it became strong when it broke structure here. It fails in its task of holding price higher. So we get a break of structure to the downside, and now we're expecting, after a break of structure, that we get a pullback. We get a pullback back up into this zone. If we're going to continue the trend, we'd want to see price pull up above this to create a new break of structure to the upside, and then continue from there, as we did in this trend. But instead, we fail, and we only manage to get, you know, a small part of the way up, and then we start to reverse again to the downside, and we break the structure again to the downside. Now we get a series of breaks of structure to the downside. Okay? And so now we're in a downtrend. Now, we talked a little bit about how in these structures we can form an actual trade idea and find an entry point, and we're going to look at certain zones and points of interest within these areas that we can take trades from later. So what we're looking to trade is the pullback into this, now what we expect to be weak structure, and we get exactly that, and we break through the weak structure. So we're going to anticipate that's going to happen, and we're going to take our trade from somewhere on this retest of the area before we drop. Same thing down here. We're going to continue down with our breaks of structure, pullback, expansion that breaks structure, and we expect another pullback, and we expect another expansion downwards. But instead, we come back up, we break through this strong high, and then, because we've broken this strong high, that becomes a break of structure, right, to the upside. And what do we expect after a break of structure? We expect a pullback. And we pull back down, back into the zone, and we're going to look for a point of interest to take a trade from. We won't worry about that now. That's going to come in the next videos. And then we expect a break of structure to the upside. Again, using the box or using the lines, doesn't matter. You can mark your strong and weak structure with lines, and your breaks of structure with lines, or you can mark the entire thing with a rectangle, as you can see in these examples. Doesn't matter. Okay. And we pull back, expand, pull back, expand, and we're in an uptrend. So you can see that this is what you need. It's this pattern here, which is exactly what we drew on the previous slide that we looked at. There's your bearish reversal pattern. Okay? And your bullish one is over here. Let's draw these out one more time so you can see them, okay? And it's going to get a bit messy on here now, but yeah, you get the idea. Okay. So those are the key pieces in how the market reverses. So in the next video, we're going to put all of this together on an actual chart to better show how it works in real market conditions. We will then see just how much even these relatively simple concepts can help your trading in a huge way. We'll also see in the future videos in this series that microstructure within these reversal patterns is what we're going to trade, and that will come from these points of interest that we talked about briefly now. So we can refine our entries within these structures to get much more precise trades. And to do that, we'll learn how we can drop down to smaller time frames to get the best entries. All of that stuff is coming up in this series and more, of course. So if you've liked this video, click the like button, leave a comment and let me know what you think. And I'll also try and answer any questions you have. If you want to see all the other content that's coming up on this channel, click the subscribe button and the notification bell. The next video will be video 3, where we'll put all of these concepts together on a real chart. And remember, if you want to follow along, a link to TradingView is in the description below. Hope to see you in the next one. Take care and thanks for watching.